Need a little extra cash to tide you over, but your credit score is holding you back? We've all been there. Car needs a repair. Unexpected bill throws a wrench in your budget. Sometimes, a short-term loan can be a lifesaver. But with traditional lenders, a bad credit score can slam the door shut faster than you can say, denied. So what are your options? Well, that's where Uprova comes in. They advertise themselves as a safe and accessible alternative for those with less than perfect credit. But the big question remains, can you really get a loan with Uprova if your credit score is, well, not so great? Let's jump in and dissect the truth about Uprova's credit score requirements, explore some alternatives, and ultimately, help you decide if this lender might be the right fit for your situation. First things first, Uprova doesn't play by the same rules as traditional banks. They operate as a tribally owned lender, which means they're subject to different regulations. This allows them to consider factors beyond just your credit score when making loan decisions. Sounds promising, right? Here's the catch. While Uprova doesn't have a strict minimum credit score, they do have their own way of assessing your eligibility. They call it their proprietary scoring system, which is basically a fancy way of saying they look at a wider range of factors to determine your ability to repay the loan. This can be good news for those with a checkered credit history. Uprova might consider your income stability, employment history, and even bank statements to get a more complete picture of your financial situation. But what does this mean in practical terms? Here's the reality. While Uprova is definitely more open to borrowers with lower credit scores than traditional lenders, there's no guarantee you'll get approved with a rock-bottom score. Here's why. Uprova still needs to make money, and borrowers with very low credit scores are statistically more likely to default on loans. So, while they might be willing to consider you, the interest rates you'll be offered will likely be on the higher side. Let's talk numbers. Uprova offers loans with APRs, annual percentage rates, ranging from 34.5% to 35.99%. That's significantly higher than what you'd get from a traditional bank. So, while Uprova might be an option if you're in a real bind, it's important to understand the true cost of borrowing. So, is Uprova the answer for everyone? Not necessarily. Here's what to consider before diving in. Exhaust all other options first. Shop around and compare rates from credit unions, online lenders, or even see if a personal loan from a friend or family member is a possibility. Be clear on the repayment terms. High APRs mean high costs, so make sure you have a solid plan to repay the loan quickly to minimize interest charges. Consider building your credit score. There are ways to improve your credit score over time, such as making on-time payments for existing debts and keeping your credit utilization ratio low. This will open doors to better loan options in the future. Ultimately, the decision of whether or not to use Uprova is a personal one. If you're in a pinch and traditional lenders have shut you out, Uprova might be a viable option. However, be mindful of the interest rates and make sure you can realistically afford the repayments. Remember, borrowing money should always be a last resort. There are resources available to help you manage your finances and avoid the debt trap altogether. With that said, thanks for watching, and until next time.